Hey traders, Raghee here. Let's kick off this premium video with a look at the trades that we sent out via alerts. We are sending out the day trading alerts, and today we focused on the NASDAQ futures via the QQQ ETF. Now, what do I mean NQ via QQQ when I send out the alerts? The idea is this: with the unpredictability that we still have, with the price movement ranges and sort of the elastic nature of this market, meaning the unpredictability we tend to see at resistance. Resistance and support are still doing a pretty good job holding, but the amount that will exceed the high or exceed the low is still incredibly unpredictable, and it makes trading the underlying ES or NQ or RTY or YM difficult at best, right? So what do? We know that we need an instrument that's going to give us more latitude and control risk, and that's when we look at the futures on the options futures, or we look at the futures alternative ETFs and play the options in those. So that's why you see when I send out the alerts something like, how did I say it today? NQ via QQQ day trade alert. Now that was the first one that we sent out. That was the first one that we focused on this morning. And the idea there was to once again fade. Now why fade? I mentioned some of this in the free video. The tendency for rollover to be bearish in a bearish environment is pretty significant. Today is rollover day as we go from the H March contract to the M June contract. So as we roll from one contract to the next, what we also want to keep in mind is the fact that we also have this limit down move. All right, we have the limit down move that is also, again, going to add to our bearishness. And even though, and I will tell you clearly that today's FinViz relative performance was tricky at best. The US dollar, when it is, and it's not very often, when the US dollar is pegged to one side or other of our one-day relative performance, remember, this is a relative performance of the US dollar versus these other currencies. So everything is going to look weaker, or everything is going to look stronger. But again, most of the day, the yen spent time either being the second strongest or third strongest currency. And even though it looked negative in terms of the percentage reading, what made it deceptive is the fact that the US dollar was creating that. So for those of you that were confused by that, let me put it this way. If it's the top one or two strength story, or if it's a top one or two weakness story, still keep that interpretation of the one-day relative performance scale in mind. Don't worry about the percentages, because what threw that off is just the immense amount of US dollar strength. It doesn't happen often, but today was that situation. And you might say, well, what triggered that? Part of it was the fact that we had the ECB. So one thing you can kind of log away or even jot down on your calendar is the fact that when we have the Federal Reserve making a decision on rates, or we have the European Central Bank making decisions on rates, we might get that kind of unusual US dollar reaction. All right, so again, we picked a side. It's so important that you guys realize one of the first things that we do in the room is pick a side. In other words, we want to be purely short sellers, or we want to be buyers, not flip around to both. Now, if you choose to do that, that's great. But you're going to see when I pick a side, it's because I believe that's the side that we're going to see the most follow through in. That's the side that's going to allow us to build a position and see the market move, in our favor for most of either the first part of the day or even the entire day. Okay, so that side was short today. Now that side would have stayed really short and really great for us had it not been for this. And for those of you that are unaware of this, you can see them on all four indices. This was yet another flailing attempt from the Federal Reserve to keep credit from freezing and to stop just this onslaught of selling in the equities markets. And you know how successful they're going to be? Zero. Okay, because this is much more difficult than when the Federal Reserve back in January of 2019 stopped hiking rates, signaled to their buddies on Wall Street with the simple word patience, communicated that we won't be hiking rates any longer, and then not just but 7 months later began expanding the Federal Reserve's balance sheet, injecting more capital, injecting more funds into the system, asset purchases, right? So you might ask, well, Rog, what does it mean if the Federal Reserve is buying treasuries across, not just the 30-year, but many of the different bonds? What does that even mean, right? Well, what that means is you look at the 2, 5, 10, 30, all different parts of the yield, and the Fed's jumping in to purchase these in an effort to keep rates low and credit flowing. Why is that so important? Because the Federal Reserve is the lender of last resort. And when the banks are not willing to lend to each other, what kind of environment does that tell you we're in? The Federal Reserve has to step in. What's known as the repo are typically overnight loans the Federal Reserve makes. They make capital available. And they've also done a 3-month repo as of today to the tune of $500 billion. Yeah, but everything's just fine, right? Okay. So what we have here is a Federal Reserve trying their best to keep credit from freezing, which is a noble pursuit. But the fact that they created this problem in the first place is why I will give them no credit. You guys caused the problem. Now fix it. And they really can't. Why can't they? Because now that there is an external problem, now there's an external nemesis. It's called coronavirus, and the public reaction, the global public reaction to coronavirus, right? We know what's happening. It's a scary thing. The Federal Reserve can't cut and print their way out of this problem. For the first time in a really long time, we're going to have true price discovery. What do I mean by that? Well, it's not going to be the share buybacks that are propelling stocks higher. Look at the last 3 columns to the right here. 2018, 2019, 2020. Shows you the drop in the buybacks from these companies who were given the largest corporate tax cut in history and chose to do what? Buy their own shares back. Take the debt on, buy their own shares back. And now what's happening? Well, all these problems just feed on each other. They're not going to do buybacks. That takes away a huge pillar that's propping the market up along with the Federal's ever-growing balance sheet. And the market's finally realizing the actual macro underneath, not just the U.S. economy, but global economies are not good when you look at headline inflation and when you look at GDP. So for the first time, maybe in a long time, folks are starting to see the macros have not looked good in well over a year, probably closer to a year and a half. Am I trying to be a fear monger here? No, but I am trying to make it crystal clear that we have nowhere near found the bottom yet. Okay, what about the bottom? We have been bearish, the S&P, buying puts for some time. In fact, what was the first catalyst? Thank you very much, Jerome Powell. The 50 basis point panic cut. When the Fed flails, the market will fade it. Or when the Fed flinches, the market will fade it. Today, the Fed flinched again. And just as I've mentioned before, panic moves by the Fed, in this case, in a huge repo, is going to be sold into. So the only reason that we weren't able to keep some of these shorts for much longer is because that particular manipulation, which is exactly what it is, hit the market. And for us, I'm disappointed. We did take profits, so I'm not complaining, but I am disappointed because this was going to be a really nice down day for us, and we were going to keep scaling out of that winning trade. And instead, what happened is the Fed came, created a very temporary short squeeze. We did the proper thing by following our plan of a break-even stop once we've taken profits. So it was a winning day for us, but boy, we really could have taken much better advantage. And notice the benefit. Except for the fact the Fed came in and did this huge repo, which is not going to happen every day or even every week. Notice that, yes, some folks who decided to pick a bottom, good for them, but that's not a trading strategy that's going to be repeatable with that kind of scale of the move. The trading strategy that is repeatable, the one that you've seen me win with every single day this week, is taking advantage of the yen, taking advantage of the psychology, looking at where we are in relation to volume weighted different prices, and pick a side. The short side was definitely still the one to focus on. And by the way, this was tough, but like I said, big money will fade it, and that's exactly what they've done. So don't forget that, gang, because there is a playbook. There's a panic playbook that we can continue to play. I love bear markets. As a trader, I love bear markets. And so one of the things I mentioned in the morning session was this, and this is really a mindset conversation. I know, including myself, many of you have investments. I get it. But that is the growth part of your life, and you must compartmentalize that. Otherwise, it's going to affect the trading side of your life. And right now, the trading side of your life is pretty important because it's the income part of your life. Yes, we have investments, but they typically have 5 to 7 year or greater time horizons. We have to be willing to sit through and understand we're playing a long game. And in the meanwhile, we'll put that concern and those portfolios on a shelf until maybe we can start wading back into the market at lower prices and better deals and blue light specials, as I like to call them. It's not yet, but we will trade this and notice how well, again, trending markets, uptrends or downtrends are our friends. Maybe remember I said choppy markets are very difficult. They're much less forgiving, but trending markets, up or down, are incredibly forgiving. What have we been doing? Waiting for highs, shorting into them. Waiting for highs, shorting into them, because that's the flow of this market right now. Again, take a look at the way we're ending up closing the day. This is what we want to do. And I will tell you, as traders go, I'm a great bear market trader. I know a lot of you know this. I'm not saying it to brag. I'm saying it to instill confidence in you, where that part of you that might be fearful for many good reasons, don't be fearful about the fact that you can trade this. We've spent all week and even last week taking advantage of this market, and some of you reported back, Ron, these are some of the best gains I've ever made. Downtrends are awesome. Yes, gang, downtrends are probably more predictable because fear is a much more predictable characteristic of humans, and the markets are a reflection of human psychology. Now, a couple other things I want to talk about. We discussed managing the natty gas short. Yeah, we pulled back from those lower lows. That's fine, gang. I feel pretty good about where we are. I would have liked us to close lower, or at least in the lower half of that candle, but I'm confident about where we are with natty gas. And for those of you that wanted to take an optional profit target, we sent that out as well, right? Sent out a natty gas optional profit target level. All right, next, gold. Why is gold heading lower? And I know a lot of folks are asking me about that. Again, when we have sell-offs in the markets like this, and we saw this in '08 as well, people will need liquidity to cover margin calls, and typically what you will see is they will sell gold, and that's okay. Again, take away the idea that gold is a flight to safety. It ain't. What it is a reflection of real yields. Now, we did a whole video on real yields last week, and it's going to be on the Simpler Trading YouTube link. We did a free video on what moves gold, and it is real yields. Okay, so do you think real yields are heading higher anytime soon? Exactly, not anytime soon. All right, so why would gold head lower today specifically? Limit down moves, massive moves to the downside like we have today, are going to trigger gold selling as people liquidate gold to cover margin calls, to cover, cash needs. All right, this is perfectly normal, and we do want to take advantage of that by buying calls into this move. Now, I fully accept that we might see, in this case, a little bit more weakness before it levels out, but you'll notice when I sent the alert out, we're buying across the 148, 149, or 150 strike, whatever is kind of affordable and works in your budget. We also looked at April 17, May 15, and June 19 expiration. Not this Friday or next Friday. We're giving ourselves time. So I know that I can sit through maybe 2 or 3 days of a little bit of weakness, maybe a little bit of chop before we bounce back up. And I do anticipate the market bouncing back up again. Gold buys have been very good to us. In fact, this almost looks identical to the same gold buy that we triggered on the 28th of February. So you better believe I play the probabilities, and we'll just do this again. Okay, so what do we have right now? Gold, natural gas, and we have been day trading the Forex markets. I sent out an early alert about the Aussie yen, New Zealand dollar yen, and even the dollar weakness, where we could buy US dollars, buy Japanese yen versus the Aussie yen and New Zealand dollar yen. And I send those out before the bell. So for those of you, and even sometimes I send those out around 8 a.m. Eastern, for those of you that are day trading Forex, really, really powerful stuff there, okay? It doesn't have to be all futures. There's a lot of great day trades in the shorter term time frame currencies. And I know a lot of you are loving that as a complement, as a confirmation to your indices trading. So it's not separate. It shouldn't distract you. In fact, if anything, it should make everything gel that much more. So again, we played puts in IWM. We played puts in the DIA, and we went 3 for 3 on those day trades. And I hope this style, this strategy is starting to gel, because we're gonna keep on doing it. Eventually, we'll go back to the underlying futures contracts when we contract back to some sort of normalcy within our hourly and expected movement ranges. But for now, NQ via QQQ, RTY via IWM, YM via DIA, ES via SPY is going to be our plan of attack, and it's working beautifully. All right, so thanks as always for joining me on this adventure, and boy, has it ever been. Look, this is not my first rodeo, gang, and I definitely want to make sure that we can keep this income, this trading part of your life as viable by giving you the confidence to realize, gang, trends are trends. We can trade downtrends as well as uptrends, and you're going to find gravity applies, because things tend to fall a whole lot quicker than they rally. And I like to remind everybody, one of the greatest traders, if not arguably the greatest trader of all time, Stan Druckenmiller, has said publicly, I've made more money in falling markets. Let that be a lesson to you, gang. Markets are going to compensate those traders that are not afraid of the way in which we're moving. The trend shouldn't matter, only the clarity should. So thanks as always, and I'll see you in the next update.